Hi, it's Dan here. I'm not a financial advisor. This is not financial advice. Anything I say or talk about is for informational, educational, and entertainment purposes only. And I want to talk about this company, SYMBOTIC, here today. They're AI powered robotics for the supply chain. So I'll read off what they do. SYMBOTIC is an automation technology leader in reimagining the supply chain with its end-to-end AI powered robotic and software platform. SYMBOTIC reinvents the warehouse as a strategic asset for the world's largest retail, wholesale, and food and beverage companies, one of which is Walmart. Another is Target. They don't have a ton of customers, but I'm going to keep reading. Applying next generation technology, high density storage, and machine learning to solve today's complex distribution challenges. SYMBOTIC enables companies to move goods with unmatched speed, agility, accuracy, and efficiency. As the backbone of commerce, SYMBOTIC transforms the flow of goods and the economics of supply chain for its customers. One thing I want to talk about is, so like I said, two of their customers would be Walmart and Target. Now they have a couple more customers, but they only have a few, right? Essentially, that's because they have a $23 billion backlog. All right. Now I'm going to talk more about this later, but I'm going to talk a little bit about it right now. So they have so much demand for what they do. As you can see, it's a short view of what they do, but so they build these little bots here, right? And they roll around these warehouses that they are pretty much fully automated. Okay. And this is going to save customers over the course of the lifespan of all the material, all the stuff they got going on, which is approximately 25 years. So they're talking about saving over the course of 25 years for these companies, 25 or not 25, but 250 million, right? And that's one of the things they talk about. And that's pretty crazy, right? But what do you think that's going to do in the way we have to understand that they're replacing the worker here, right? And so it may even be better. As far as I know, this company is a really innovative company, and that they're probably going to continue to innovate to be better over time, right? And we understand that that's what they're going to try to do is, create more and more value for their customers, then in the long run, will they be saving more than 250 million? And they're not just going to go after these big wholesale, as they were talking, big wholesalers and retailers like Walmart and Target and UNFI and a few other choice companies I'll get to here in a little bit. But they're going to go after the smaller customers too. They're building a bot. I forget what it's called. They mentioned something about it. Ice break or break ice, something like that. I can't remember exactly. Anyways, it's a smaller bot meant for smaller retailers and smaller stores and smaller customers. And they're working on that. And they said they're no longer in the prototype stage. They have it built out. They just haven't started selling it yet. Okay, that's a thing. No, it's called Break Pack. That's what it's called. But we have to understand we've got $23 billion in backlog orders. And this company, I'll just go straight into the news release for their last quarter. And we'll get down to the nitty gritty on some of the things. So SYMBOTIC, a leader in AI-enabled robotics technology for the supply chain, announced financial results for its first fiscal quarter of 2024 ending December 30th, 2023. SYMBOTIC posted revenue of $369 million, a net loss of $13 million, and an adjusted EBITDA of $14 million for the first quarter of fiscal 2024. In the same quarter of fiscal 2023, SYMBOTIC had revenue of $206 million, a net loss of $68 million, and an adjusted EBITDA of $16 million cash. Cash and cash equivalents, restricted cash, and marketable securities on hand increased by 129 million from the prior quarter of 600, or from the prior quarter to 677 million at the end of the first quarter. This is due in part that Walmart exercised all its warrants for $10 a piece, which gave the company an extra, I think it was 129 million or something like that. They talked about it in their earnings call. But check that out, right? In just a year, they went from, 206 million to 369 million. That's incredible growth. That's absolutely incredible growth. And they dropped their losses substantially from 68 million to 13 million. So that's all headed in the right direction. Now, one of the other things they talked about in an investor presentation, which I'll bring up here in a minute, is that they have a $500 billion total addressable market. Now, how true that is, I don't really know, but if they're saying it, then, it's got to be close to that, right? I'll keep going. Fiscal year 2024 is off to a solid start with strong financial and operational results. I am pleased with the trajectory and goals we have planned for the rest of the year, said Rick Cohen, Chairman and CEO of SYMBOTIC. We will continue to innovate and build deployment capacity to support growth and increase profitability for our stakeholders. First quarter 2024, well, let me finish. So when he says, and increase profitability for our stakeholders, so they plan on going profitable. And, if you look at their losses over time, they have come down significantly. And so we'll see, with a huge amount of demand and $23 billion in, a backlog contracted already to its to its 9 customers. I believe it has 9 or 6 or 7 customers. Actually, I believe that they're going to continue to expand, as they said they were scaling in the earnings call. The first quarter 2024 revenue grew by nearly 80%, right, compared to the same period a year ago, and we posted our second quarter of positive adjusted EBITDA, said SYMBOTIC CFO Carol Hibbert. We initiated 5 system deployments and completed 3 systems during the first quarter as we delivered for our customers with a focus on excellence and speed of deployment. For the second quarter of fiscal 2024, SYMBOTIC expects revenue of 400 to 420 million and adjusted EBITDA of 12 million to 15 million. Okay, so we're probably looking at about right around the same amount of losses in net income, right? Which is good, and they're pretty much in line with last quarter on adjusted EBITDA, right in the same area. Okay, but prior the prior year's quarter, this is another quarter of over 50% growth is what they're projecting out. Okay, all right. Now, this is something we already read. We'll go to and see if we can't find an investor presentation. Check this out. So we're just going to go through and talk about some of the stuff they do. End-to-end AI-enabled SKU agile warehouse automation system with integrated omni-channel, highly visible growth profile, with 23 billion contracted backlog with blue chip customers. So if we can understand how much money that actually is. So in the prior 4 months of operation, this company has made somewhere in the neighborhood of 1.3 billion in revenue. And that's, 23 billion in backlog as they scale, like they say they're scaling. And we'll go over this. That number per quarter is going to increase significantly. Which, if it increases significantly as I see happening, as they see happening, as they talk about how it's happening, especially on their earnings call or in the last earnings call, then we got to understand that the opportunity for growth is absolutely huge. Can this company be doing close to 1 billion a quarter here soon in the next year or two? This could be, in my opinion, I think this is going to be a for sure double up on stock price. Who knows? I could be wrong. But I think that it could go, that's like my conservative estimate that this is a double up, especially if they start going profitable. Not just adjusted EBITDA profitable, but net income profitable. And leadership position transforming 1 trillion of market spend. And they say this is an annual $500 billion market. How true that is, I don't know. But we'll just go through. Cut past the risk factors. It's all about, the risk factors talk all about forward-looking statements and so forth. That's all I get? Hold on. Oh, I don't know why he had me all the way down there. I was like, where's everything at? Anyways, so reimagine the supply chain with artificial intelligence and robotics and transform the distribution network into a strategic asset, right? Okay, here we go. SYMBOTIC at a glance. Their key operating metrics. So they have 35 systems in deployment. Now, they're not going to make a ton of money, but, on services and stuff, obviously they're going to be servicing these, every once in a while because machines do break. But, companies are going to opt for these machines even if they break because guess what they don't do? These machines don't do. They don't call in sick. The machines don't go out for a smoke break. The machines, even if they break, they aren't going to sue you for getting hurt. You're not going to have to pay workman's comp. You don't have to pay health insurance or 401k to the machines. They don't bitch and complain about how hard work is. They don't go slower when they're mad. All these things. Think about, like, if you've ever been at a job, a labor job. I'm a UPS tractor trailer driver, so I see this a lot. Where, and they don't purposely break shit, because they're mad. I see that a lot at UPS where somebody's mad and they just throw somebody's package. Like, what? Dude, that's not, what if that was your stuff? You know what I mean? Think about it like that. But that's why these companies are going to opt to go this way. Because it makes sense financially. Now, in the long run, does that hurt the consumer in a massive way? Yes. At what point does automation overtake the ability for humans to pay for and consume enough to pay for these robots to make sense? You know what I'm saying? Because how many jobs are going to get displaced, right? How many jobs get displaced? And eventually it hurts these companies. But it's going to take years and years and years. Think about all the truck jobs. Think about all the warehouse jobs that this AI stuff is going to replace. Think about all of the jobs in total. And I live in Missouri, so it's good money in Missouri. I make like $135,000, $140,000 a year at UPS, right? What happens if they take my job away? Where am I going to go to make that type of money? You know what I mean? Obviously, you can't displace electricians and plumbers and stuff and jobs like that yet. But who knows what happens if that happens? What happens if that, goes down? Or, I'm guessing mechanics is a job that you can't really, really replace with a robot. I mean, unless you have a humanoid robot who can bend their arm in certain different ways. But look at that. Tesla's working on that. Optimus. And as far as I'm concerned, I have shares in Tesla. And I think that they will and eventually figure that out. And so I'd rather be invested in the companies that are going to take my job away. Not because I want it to be on, but because if they're going to yank my job, then I might as well make money off of that. You know what I'm saying? And that's sad, but it hurts. but my idea is to put myself in a position where I'm not screwed. You know what I mean? Anyways, so their key financial metrics is they're 98% year-over-year revenue growth, which is absolutely incredible. Almost 100% year-over-year revenue growth, incredible. We already went over the $23 billion in backlog and $500 billion annual. So that's the key word: annual total addressable market. So even if they weren't the only player in this space, they're set to be a monster. And they have positive cash flow. All right. And so here are some of their customers. I don't know who Giant Tiger is, but I do know who Target and Walmart are. And I don't know who CNS Wholesale Grocers is. I don't know what the A symbol. UNFI, Albertsons, GB, and SG. I don't know who GB is. I think GB is a partnership they did something on. SG, I can't. The print is so fine that I can't read that. But that's crazy to me, right? And think about this: Kroger and all the other big grocers. Think about like the entire world, because they're going to go for the entire world. They have the 350 issued patents, so they got a lock on a bunch of this over the coming years. They got a pretty good lock. You know what I'm saying? With their patents on their machines. Now, somebody else can come up with a different idea and a different style of machine. Blah blah blah. You know what I'm saying? Anyways, SYMBOTIC addresses existential threats. So, existential threats: labor pressures, evolving omni-channel strategies, SKU proliferation, addressed by, SYMBOTIC's AI-powered automation, right? So here's a view of what they're doing, essentially. So you're going to back the trailer up onto these doors. Their machines, I guess, you're probably going to have people still unloading. I think that's what they're talking about. They still have people unloading, but you're going to unload, and then these things right here, we'll drive them and put them onto these shelving systems. And then other machines or other things like this, other robots, let's call them what they are, they're robots. They're going to drive them out to these outbound cells and load them onto trailers, all right? Solution differentiator. So AI-powered software, a turnkey retrofit solution, modular system design, case-level storage, which we see up here, case-level storage. And then fully autonomous bots, native case handling, right? It has unmatched efficiency, speed, flexibility, density, and accuracy. All right. So first principles of the 1 trillion supply chain. Automized buffer to move. So they go from the manufacturers and wholesalers. They put their stuff on pallets. They load them up in put them on pallets or whatever, and case them up, and then they put them on the tractor trailers. And send them out to the retail stores or the micro fulfillments or home delivery. So I'm guessing in a way of like sending trailers to UPS or like or like a FedEx or an Amazon. You know what I'm saying? Which, by the way, I think Amazon probably ends up being one of their customers. At some point in time. Even though Amazon warehouses are already highly automated, and I'd like to understand who their customer is. You know what I mean? Anyways, their quantity mismatch, timing mismatch, location mismatch, resource intensive. So they're going to automize to align quantities, buffer to align the timing, move to align the location, and reduce resource use. Reduce, customers, or reduce workers, rather. Warehouse management alternatives. So I'm assuming they send these out to these companies here, a bunch of their stuff out to these companies, to Amazon and so forth, which would be your micro fulfillment, blah blah blah, right? Your tangible benefits and your powerful ROI. So you're going to have dramatically lower operating cost, 5 to 9 times outbound efficiency improvement, 30% 30 to 60% footprint reduction. I'm curious as to how they're going to do that. At 99.99% task accuracy, they're going to increase the pallet capacity. So, with these machines being as accurate as they are, it's going to allow them to build better pallets tighter, right? Better than humans would. Lower transportation costs, exceptional SKU agility, and faster inventory turns, fewer stockouts. An example: customer pays $50 million for the system, so that's what they're charging per system. Wow. So if they charge, so if we understand that they have, I think they said they were completing systems every 16 to 20 months. They said they could do it faster, so we'll see. On the earnings call, they definitely said they are certainly able to do it faster. But let's just go through this. $50 million for the system, inventory reduction becomes $50 million, saves customer $10 million per year over over 25-year useful life. It saves the customer $250 million over 25 years. What customer isn't going to do that? I mean, think about the profitability or the ability to return dividends to shareholders. You know what I mean? Or value back to the shareholders with that. They have a deep competitive moat. So they have 350 patents issued and they have 500 plus patent filings. All right. 600 million cumulative R&D research and development spend. So that's a lot. But it's over 16 years, so not as bad as you might think. They have global patents awarded 334 plus, 100 million annual R&D budget, and they're on a journey towards 7 Sigma. I'm not sure what that means. I looked it up, and I really didn't get the answer I thought I was going to get, so I'm not even going to talk about that. All right, and essentially they build mixed pallets of cases and eaches. I don't know what it means by eaches, to deliver more SKUs with less inventory, all through a common infrastructure. Their key customer case studies: so CNS Wholesaler, Albertsons, and Walmart. CNS Wholesaler or wholesale grocers, largest U.S. wholesale grocery distributor in the U.S. Second largest U.S. supermarket chain by revenue, and Albertsons, and your world's largest company by revenue in Walmart. And GB is a joint venture between SYMBOTIC and SoftBank. I'm assuming that it's got something to do with new technology of some sort. Maybe BreakPack is that the robot that they were working on that I talked about earlier. I couldn't remember the name. Now, the Greenbox joint venture is SYMBOTIC and SoftBank, and the ownership in the Greenbox, right? So what it looks like is they're going to build these warehouses and they're going to rent them out. What I would assume that would be more money for SYMBOTIC, and it would be annual recurring revenue. You know what I mean? Because they'll be renting them out, which some customers might, do that because then they won't have to pay. I'm assuming that the rent has services built into it. Well, I don't know enough about that, but I also don't have much about that yet. This is something they're working on. Greenbox enables significant new incremental total addressable market for SYMBOTIC, broader access to SYMBOTIC technology and associated efficiencies demanded by customer proof points. Greenbox creates another powerful customer proof point for SYMBOTIC long-term customers, first step in potential longer-term relationship with Greenbox. Attractive tailwinds. Put SYMBOTIC at the center of growing logistics outsourcing trend, cost-effective and scalable, enables attractive variable consumption model for customers, provides competitive edge, enables leading efficiency and accuracy for a broader customer segment. So For Symbotic, 432 billion in-house, one-time system sales, and operate our own warehouse. All right. So maybe this is just their whole thing here. Instead of it just, maybe this is just instead of renting it out, which I think that would be a great idea if they rented it out, incremental annual warehouse as a service opportunity. That's what it sounds like they're trying to rent it out. I have to go deeper into that. That's what it sounds like to me. But long-term growth strategy. So they're looking for a longer-term, ordeal here. Multi-vectors for potential growth. So increase existing customer penetration. CS, Albertsons, and Walmart. So essentially build more facilities for those companies, which is going to be probably part of their $23 billion backlog. I would imagine that CNS, Albertsons, and Walmart has already said we want to do every facility just like this one. I'm assuming, I don't really want to make assumptions, but that's what it looks like. You know what I mean? When new customers in existing verticals, grocery, general merchandise, UNFI, AFS, add new verticals, so they want to go into not just grocers or wholesale companies, but they want to pretty much go across all the warehouse segments is what it looks like here, right? And then they want to go add new geographies. Basically, they want to go worldwide and they want to expand their product suite. So, like I said earlier, they're going to continue to innovate, right? And we'll finish off here with a few things. Symbotic's key financial highlights: visible growth profile at scale, highly visible growth underwritten by 23 billion contracted backlog, which is where CNS, Albertsons, and Walmart come in, right? High margin, annual recurring revenue base building over time from software and parts and a service base. Their gross margins is somewhere around 64%, if I heard correctly in the earnings call. Maybe I'll go over some of the earnings call stuff in another video that I thought was, where I think that is pretty good. Significant operating leverage with expanding EBITDA margins. So they're going to continue to try to expand their EBITDA, which, I think they'll be able to. CapEx, so capital expenditure light business model, that supports strong free cash flow conversion. And we want to see that because that's going to contribute to profitability over time. Okay, so and a recap of their business model. So they're going to build capital asset sale revenue spread over 2 years, milestone payments. Required to use system annual recurring high margin revenue long-term contracts. Add HOC support. So that's going to be your services and parts. Symbotic sells highly advanced AI-powered warehouse automation systems with supporting software and maintenance services over 15-year contracts. So they're creating long-term recurring revenue streams with these 15-year contracts. That's about all I want to go over. I do want to say that, their revenue is 98% year over year. Their adjusted gross profit up 116% year over year. Their gross margin up another 150 basis points year over year. R&D is up 12%. So their R&D is up at a small fraction compared to their revenue year over year. Now SG&A is up 37% year over year. We don't really want to see SG&A up so much. That's something I don't really like to see. I want to see it, SG&A going down would be preferred, or stable, preferred, more so than up a pretty good chunk like that. But their adjusted operating expenses is up 23%. We really, as a percentage based on to revenue, it's growing less than revenue, so that's good, right? Their EBITDA margin is up 1,400 basis points. CapEx is up 20%, so capital expenditures. We want to see that lower, over time. Their free cash flow is up 63% year over year, which is strong, which is good, right? Reconciliation to gross profit is up 1,500 basis points. Their gross profit is up 90%. Their adjusted gross profit is up 116% year over year. Adjusted EBIT is up 80% year over year. And interest income is up 1,053% year over year. And then we're going to skip down to their net loss, though, is up 49% year over year, which I don't like at all. We want to see that come down. We want it to not be a net loss. Well, you know what? It might not be net loss because it would seem, you know what? It's up. Okay, so their net loss decreased. My bad. Their net loss decreased 49% year over year. And that's something we want to see. All right. But that's all I got. This video has gone on for quite a bit of time. If you like the video, please like and subscribe again. And thanks for being a part of the journey. Appreciate y'all.